Hello everyone, I'm Dr. Stock. Welcome to my options education series. In this series, what we're talking about is learning about the different forms of options. We're going to start off talking about just a single perspective. So if anybody who has any prior knowledge of options trading in the stock market, this video might start just a little bit basic, and the parts that will follow this one will start to get a little bit more advanced in terms of terminology and different strategies that you would want, and also other meanings such as the option Greeks. For right now, this one it's intended to start at a very basic level, one that if you don't have any exposure or you don't understand anything about options in the stock market, this is the video for you. And if you have a little bit more knowledge or more of an advanced knowledge, then as the series unfolds, you might want to check out some of those later videos. So this is intended for the complete beginner, and we're starting with a single perspective, just talking about buying call options. This video is very vocab light. We don't really get into the specific words. That would be the next video where we start to learn more of the language surrounding options and the different things that we would want to look at. The strategy videos are one of the final things that we get into in this series. So I do want you to be aware of that as we go forward. So without further ado, let's get on to the options education, buy and call options for the complete beginner. All right, so here's the scenario. You want to know, should you buy stock directly or should you buy a call option? So the scenario is that you would like to purchase 100 shares of common stock at $10 a piece, and also you expect that price to rise considerably over time. So that's really key for this, is that the price is expected to rise as we look at this. So you basically have two choices. One, you could buy those shares directly on the open market, or two, instead of buying the 100 shares in the open market and using all that capital, and we'll get more into the reasons later, another option that you have is that you could buy a call option that would give you the chance to have the $100 at $10 each. So we'll talk about the differences between those two choices, and also which one is the better choice, which is kind of a difficult question to answer. So we'll watch as that plays out in the video. All right, so first let's talk about choice number one. For choice number one, we're going to look at buying the 100 shares directly on the open market. So the shares are $10 each. You're going to purchase 100 shares of them, and if we multiply the price per share times the quantity, we're going to spend $1,000 for those 100 shares. So the reason that I start here is that this is typically what people think of when they go to first enter the stock market, when you're first learning about the stock market. And since this is for the complete beginner, I felt like buying a call option was the most straightforward approach that I could take to starting the options. Here's just a couple of details. One, you paid $1,000 for that 100 shares, and you now own them. Any appreciation in that stock whatsoever is yours. It stays as an unrealized gain, meaning that you haven't taken that money until you sell those shares, but all of it, every penny of it, is all yours. And also, the other side of that coin is that all of the depreciation, any amount that stock should go down once you buy it, that's all yours as well. If you buy those 100 shares directly, that's what you get to look forward to as far as appreciation. So the stock goes up, your gains, or the depreciation, the stock goes down, your losses. Choice number two. So something, instead of buying the shares directly and spending that $1,000, here's what you can do. You can buy the call option. It gives you the chance to buy the 100 shares at $10 each. And I know that that sounds a little bit weird, but just stick with me and we'll make more sense of it later. All right, so here's the basic scenario. You're going to pay $1 per share, and for that contract, for that call option that you're going to purchase, every contract comes in 100 shares apiece. So it's going to end up costing you $100 in premium for that contract. So let's look at some of the details about how this will play out if you do choose to purchase that call option. You paid $100 just for that one call option contract. All of the appreciation above $10 is yours, but look, only if you choose to buy the stock. It's also noteworthy that none of the depreciation below $10 is yours, because you'll choose not to buy the stock if it is below that $10 mark. Now, I know that that might seem a little bit strange, that you're paying $100 just to have the chance to buy the 100 shares. It seems like you're already putting yourself at a deficit of $100 right off the bat, and it seems like a guaranteed loss. Why would you take that, though? It doesn't really seem to make any sense whatsoever. Here's a few more details that you want to know, and then we'll get on to more of those details as to why this is an option that you may want to take. Once you purchase that contract, it's noteworthy that you own none of the stock. It is not yours until you exercise your right to buy them. You should also know that for the contract, at or above $10, you have the right to buy those 100 shares of stock from the contract seller for exactly $10 each. That means no matter what price that stock should go up to, you have the right to buy them. So that stock could go up to $12, you only pay 10 each. That stock could go up to $20, you only pay 10 each. That stock takes off, it hits $100 per share, you still only pay $10 per share to the seller, and you get all 100 shares. So that's an advantage that we have, that you're guaranteed to only pay $10 per share when you exercise your right with the call option to buy those 100 shares of stock. If that stock price should fall below $10 per share, you absolutely do not want to exercise your right to buy the 100 shares from the contract seller, because you can get it cheaper just by buying those shares directly from the market if that's what you wish to do. If you exercise your right and that stock price does not come out to at least $10, you're spending more money than you have to for those shares. So people who are in options will not exercise their right if it's below that price of $10. All right, so on this slide, we ask the question, what does it make sense to buy the call option and exercise your right to buy the 100 shares? So if we look at the table here, it's $1 per share to enter the contract. The stock price is $10, again, per share, and so that totals $11 per share if you're going to take this contract. This is one that you would want the stock price to be at least $11 per share before you even break even. So when does it make sense? It makes sense to exercise our right to buy this stock at or above the break-even price of $11 per share. So, which choice should you take? Take a look here at this table that I've made for you. When we're looking on this side over here, you can see it says buying the stock outright. So you just go into your brokerage account and you say that you want 100 shares of this company for $10 per share, and you can look and see that all these gains that you have all the way through here, these are all yours. And when you compare them to the gains that you have over here, if you choose to buy the call option, at $10, you've lost $100. At $11, that's your break-even price that we had just talked about. And notice that all of these gains that follow, they are all $100 less because you paid $100 for the contract in the first place. So you're essentially getting less money for buying the call option contract. It's counterintuitive. I know that it seems as though you shouldn't make that purchase. It just seems worse. But take a look at the next slide. When we take a look at the losses that you could incur in buying the stock outright, which is over here, versus buying the call option, look at those losses. At $10 even, you lost no money buying the stock outright. At $9 per share, you lost $100 if this stock goes down in price. And then look at all the other losses. If this stock goes down to like $6 per share because it had a really rough time recently, maybe it had some bad news, some terrible guidance going forward, it didn't hit the revenue or earnings targets that you were looking for, just whatever it could happen to be, look at all this money that you could stand to lose versus look what happens if you're wrong about the options contract. You spent the $100, and no matter that price that the stock gets down to, you only spent $100. You never actually even bought the shares. You just paid $100 to have the chance or the choice to buy those shares from the contract seller. So this is a way that we could limit our downside risk. So you're saying to yourself, well, I think that this stock is going to go up in price, so I'm going to buy a call option. And if it does go up in price, I can buy those shares. So in other words, you're paying $100 to wait and see if you're right. If you are right, well, then you have some gains. And you only spent $100 on that gamble that you were right. Whereas when we're looking over here at buying the stocks outright, you have to spend the $1,000 and wait to see if you're right. And if that stock depreciates, then dollar for dollar, you lose as that stock does depreciate, regardless of where it should happen to stop. So just a little bit of a side-by-side. Here's choice 1, buying your 100 shares directly. It cost you $1,000. Gains $100 greater than choice 2. The gains are guaranteed to be $100 greater than choice 2 all the time because you paid $100 just to have the opportunity to buy those shares with the call option versus when you buy those shares directly from the market, those shares are yours. The greater loss, though, is also possible when you buy the shares directly from the market, so that's something else that you need to be aware of. Take a look at choice 2, which is buying the call option, where you have just the right to buy those 100 shares at $10 each. You paid $100 to have that right to buy them from the contract seller, and if you do exercise that right, then it costs you $1,100 instead of $1,000. The gains are always going to be $100 lesser than choice 1. Not great. However, it has a limited loss, and you can also wait and see with the call option. It affords you that time to see if you were right or if you were wrong about how that stock's price is going to change over time. So something else to consider. Choice 1, buying the shares directly. You spent $1,000 of your money, and that stock is being held by that equity, by those stocks. That $1,000 is used until you do something to cash out, that you sell those shares to either make your money because it went up in price, or to get your $1,000 back because it stayed the same, or to get some money back because it went down in price. That $1,000 of your cash is in use. It's tied up until that's done. There's also a benefit that it has is that there's no time limit for buying and holding the stock. So that's something that you want to think of. Choice 2, it only uses $100 of your investment. So if you're somebody with limited capital and if you're a new trader, it's very likely that you have limited amounts of money to put into these things. Buying the call option can be a really good opportunity for us to not spend so much money, wait and see whether or not we were right about how that price was going to move. And if that stock does appreciate, if it does go up in price where it goes to $11 or beyond, remember $11 per share is our break-even point, so we would make no money. We would just break even on that. Anything above $11 and, well, then we have a gain, and we only spent $100 waiting to see if we were right. So we can think of that as being an advantage. A trade-off is that you have a time limit on how long you have that right to buy the stock. So this summary here just goes over choice 1, and it breaks down some of the things that we had talked about. So buying the 100 shares directly, greater gains, but also greater losses. All of the gains above $10 per share are yours. All of the losses below $10 per share are yours as well. So when you go to make that purchase directly from the market for those 100 shares, it takes a substantial amount more of your money in order to make that happen. And so it uses up more of your capital that can't be used to be invested elsewhere because it's currently tied up in that stock. For choice 2, still the same scenario. It's just that now, instead of buying it outright, we buy what's called the call option contract, and it has a limited loss equal to the premium you paid. So we paid $100 to have the right to buy these shares, and that is the maximum loss that we can experience through this sort of option, or through this choice versus buying the share outright from the market. And after you take out that premium, after you take out the amount that you paid for the contract, all of the gains after that are yours. But that's only if you decided to exercise your right to buy those shares. Your losses are limited, $100, that's it. Forever and ever, for the life of this contract, however long it lasts, because they do have a limited amount of time, your loss is also limited to just that premium that you paid. In this case, for our example, $100. A benefit here, takes a lot less money to buy that call option to wait and see if you're right. You still need the money in order to purchase those shares, so you still need another $1,000 on the side waiting to go in the event that you can buy these. I would remind anybody watching this who knows a lot more about options and option strategies. I know that I'm really simplifying this, and I know that I'm glossing over a lot of things, and that you don't have to exercise your right to buy. There's a lot of different things that you can do. This is meant to be from a single perspective, and right now it's based on wanting those 100 shares of the company and either buying them from the market directly or buying them via call option. So what's next? Right now, I don't recommend that you go out to the market and that you make a purchase of a call option because there's a lot more things to consider. I left out a lot of vocabulary, so here that I call them key vocabulary, things that you want to know and things that you want to learn about and study. And in my next video, we get into some of these keywords, specifically the words that you see here. I know that there's a lot of them: options contracts, contract writer, contract holder, strike price, option premium, expiration, exercise of the contract, assignment out of the money, at the money, in the money, break-even point. I know it sounds like a lot at first, but if you familiarize yourself with these concepts over time, we have addressed pretty much all of these concepts, all of these vocabulary words throughout this video already. We just didn't put them in their proper places. So in the next video is where we will take these words and give them some basic meanings, and we will also get more of an advanced meaning that connects with it, and I have those also broken down for you. And also I extend the same scenario that we have, just now bring that vocabulary in and really bring in some more visuals to help you really further conceptualize what's taking place when you're buying a call option. Other things that we would have in the future after we go through the next video on key vocab, instead of call options, we talk about put options. Put options are a different sort. It's a different perspective that I'm not going to go over now, but it's definitely something that you would also want to know about if you're going to work with options in the stock market. In a video following the one on put options, we'll get into some more advanced topics, the role that time plays, also the implied volatility that's in the stock market, the ask price, the bid price, liquidity. These are all different concepts that we need to consider, so I didn't want to put it in the video now because I don't want to overwhelm you now, but it is something that we will see in a future video. There's also the option Greeks to learn about, delta, gamma, theta, vega, and rho, and what each of those mean and how we use them in our trading. Following that, we get into the option strategies that we have. So this is going to be a longer series, and it is one that is meant to be a ground-up education for you. So from the complete beginner up to a level where you feel more confident, where you can go through researching more about the different strategies and working to understand these concepts better, and you can get into paper trading with your options where you use pretend money in order to trade them and really test out your strategies, see how they're working for you, and eventually get into trading with real money, with real stocks. And as we do that, I will bring through more and more authentic situations to tie into these videos, ones that aren't so contrived as what you would see here. So that does it for beginner call options. And again, this is for the complete beginner, somebody who has no concept about options, or maybe it clarifies for some people who have watched some other videos. And again, the reason that I wanted to start with buying call options is because it's from a perspective where most people, when they first get into the stock market, think about buying a stock and waiting for it to go up in price. And so buying a call option is another case where you could buy a contract, a call option contract, and allow that stock to go up in price, but before you exercise your right to buy it through the call option contract. I will let more of that play out in the next video. For right now, I really appreciate you guys stopping over. If you want to check out my Patreon, there's a link down in the description. There's also one down in there for WEBULL, which is a trading platform. If you sign up and deposit $100, you get 2 free stocks. I get 2 free stocks. It helps the channel. I really appreciate you guys stopping by. Let me know how you like this video in the comments, and I'm really excited about this series, and I can't wait to share the next one with you. I'm Dr. Stock. Thanks for rocking with me. Now go get that money.